Most people hear about tax strategies online and think, I'll just buy real estate and pay no taxes. But the reality is, if you don't understand passive activity loss rules, then you probably don't understand tax planning. This is one of the most important concepts in all of tax planning. Understanding passive and non-passive income is the foundation to many of these advanced tax strategies used by business owners and real estate investors. A passive activity is any activity in which you do not materially participate. The most common example of this is rental real estate. So even if a property generates a large paper loss due to depreciation and other expenses, that loss is generally considered passive. And this matters because passive losses can only offset other passive income. That means if you have W-2 income or other active business income, those rental losses do not offset that income. Now on the other side, you have non-passive income. That's typically income you actively work for. Things like business income, earned income, W-2 wages, or guaranteed payments. Those are examples of non-passive income. And only non-passive losses can offset those forms of non-passive income. Once you understand the difference between passive activities and non-passive activities, you start understanding why certain strategies work and why others do not. We're gonna break down things like material participation, short-term rental loopholes, the real estate professional status, and how business owners and W-2 employees are using these rules strategically for their tax planning. We talked about passive versus non-passive activities. Now the question becomes, how does the IRS determine whether you're actually active within the activity? The answer is material participation. This is one of the most important concepts in tax planning because it helps the IRS determine whether you're non-passive or passive within the activity. A lot of people think that if they own a business or they own a rental property, they can automatically use those losses against their income. But the IRS wants to see if you're actually involved in the activity in a regular, consistent, and substantial basis. There are several material participation tests, but the most common test we see is the 500-hour test. If you spend more than 500 hours participating in the activity during the year, you will qualify. There are other tests too. If you're doing substantially all the work yourself and participating more than anybody else, that also qualifies you without having to hit the 500-hour test. And this is where tax strategy becomes important. Because if an activity is considered non-passive due to material participation, you can then use losses from that activity to offset other non-passive income, like your W-2 income or other active business income. But documentation is critical. You cannot just estimate your hours after the fact. Logs, calendars, emails, management activity, and management hours all matter. We're going to talk about short-term rentals and why they're treated differently under the passive activity loss rules. Now let's talk about why short-term rentals are such a major topic in tax planning. Normally, rental real estate is automatically considered passive under the tax rules, even if you materially participate. That means those losses can only offset passive income. But short-term rentals can be a little bit different. If the average guest stay is 7 days or less, the activity may not be treated as a rental activity under the passive activity loss rules. And that's where things get interesting, because if the activity isn't automatically considered as passive now, material participation starts to matter. So if you materially participate in a short-term rental, losses from things like bonus depreciation and cost segregation studies now become non-passive, allowing you to offset other non-passive income like business income or your W-2 income. This is why so many high-income earners and business owners pay attention to short-term rentals from a tax strategy perspective. But this is also where a lot of misinformation exists online. Not every Airbnb and VRBO qualifies. The average rental stay matters, your participation matters, and your documentation matters. You also need to properly structure and track the activity to support your position on the tax return. When done correctly, short-term rentals can become a very powerful tax planning tool because they can create losses that are not trapped as passive losses. We've talked about passive activities, material participation, and why short-term rentals can sometimes avoid passive loss limitations. Now let's talk about one of the biggest concepts in real estate tax planning. Real estate professional status, also known as REPS. REPS is a very specific IRS designation, and qualifying can completely change the way real estate losses are treated. Normally, rental losses are considered passive and only can offset other forms of passive income. But if you qualify as a real estate professional and you materially participate in your rental activities, any losses generated from those activities are now considered non-passive and can offset other forms of non-passive income like business income or your W-2 income. To qualify, there are two major tests. First, you need to spend more than 750 hours per year in real estate activities. Second, more than half of your total working time for the year must be spent in real estate trades or businesses. So if someone has a full-time W-2 job and they work 2,500 hours a year, qualifying for reps becomes almost impossible. And just like material participation, documentation is critical. Time logs, calendars, meetings, property management activity, and real estate involvement all matter. This is why reps can become such a powerful strategy for married couples, especially if one of the two spouses is heavily involved in real estate activities. But it has to be done correctly, because this is an area that the IRS pays close attention to. Tax strategy is not just about buying real estate and creating losses. It's about understanding how passive activity loss rules actually work and correctly structuring your activities around them.